All right, good evening, everyone. My name is Xavier Duran. I am the Adult Programming Director, Coordinator for the Lyle Library District. A couple of things before we begin. We are in what's called webinar mode, which means only myself and our presenter have active cameras and microphone, which means that in order for you to communicate with us, you need to drop any questions into the Q&A feature down below, and we will answer questions. Do you want to answer questions during the program or at the end? How do you feel, Judy? We'll take them towards the end of the program. With that said, we are in webinar mode, so if you're having a late dinner, feel free to have keep eating your dinner. You won't be on camera. With that said, I'll go ahead and introduce our wonderful presenter, Judi Strauss, PhD, EA, owner and principal of Strauss Financial and Tax Services, has offices in Downers Grove and Chicago, Illinois. For more than 35 years, she has provided personalized income tax and year-round financial planning services to individuals and small businesses, many of whom have been clients since she began her business. Judi holds a PhD degree in Human Services Management from Union Graduate School and has earned her degrees from Harvard University, as well as the University of Pennsylvania, where she received her Phi Beta Kappa Key. She is a member of the National Association of Tax Practitioners, the Illinois Association of Tax Practitioners, and the National Association of Enrolled Agents. So please welcome Judi Strauss.
Hello, everyone. I miss seeing you. This is Judi Strauss. And first of all, I looked on my phone before we started this and I discovered it was 4 degrees in Lyle, which is pretty darn cold. So it's not a bad thing that you're all on Zoom. I will tell you one of the things I love about doing taxes is doing taxes with people. I will tell you that 2020, 2021, and now 2022 are really different years. We have been working very diligently to make sure everything gets done, and you'll hear what's going on with the IRS in a minute, but I will tell you, we have seen some people in person with masks, and we have a plexiglass shield that sits over my desk. We have seen a lot of people who have either dropped off their tax returns, I've done them, and then either we've Zoomed with them like we're doing now, or I've talked to them on the phone and explained what's going on. We've had other people yet where my office manager, and many of you remember Beth Austin, who is still with us, where she has picked up tax returns and then dropped off tax returns. So all in all, it's been a very interesting, challenging year at best. That's number one. I'll talk about, as I said, the IRS in a minute. Number two, so you all know, part of the reason besides COVID that I'm on Zoom is I was one of the fortunate people that sold my house in Downers Grove in less than a week. So I've lived in my house in Downers Grove since 1969, and somebody made me an offer that I couldn't refuse. And so I decided I've always had a condominium and an office in Chicago. And at the moment, I'm sitting in the middle of my Chicago office. What we are doing for 2022, for those of you that are my clients or those of you that may want to get a hold of us, we've done several things. One, the number that people know to call me at, which is 630-964-4018, now resides in this lovely new cell phone. And so that number, if you call it, either Beth or I will pick, hold on, either Beth or I will pick it up and talk to you wherever we are, whether I'm in my condo, whether Beth's in her house, the phone is there. Number two, for 2022, and I don't know whether it's going to be permanent or at least whether it's temporary. We were very fortunate. I now have an office in Downers Grove, 5 minutes from my old house, that will be open for business the first week in February. Most of you will know exactly where it is, or you can drive by and find it. The address is 6900 Main Street in Downers Grove, Suite 209. So if you know where the Amita Urgent Care is on Main Street, south of 63rd Street, or you know where McCullum Park is, it is just south of the Amita Healthcare Building on the west side of the building. There is parking in front, there is handicap parking, there's an elevator, and we are on the second floor. I'm getting, the furniture is in, the internet will be in on Thursday. And so if you are a client that wants to come and see me and you've been an existing client, we will do you in person in Downers Grove, and we will figure out a schedule to do that. I'll probably be out there 1 or 2 days a week. Otherwise, it's more than fine for you to call us, mail stuff to us, FedEx stuff to us, drop it off at the Downers office, and Beth will bring it into the city, and then we will bring it back to you. So that's been an interesting challenge. I am not leaving the people that I really care about. But on the other hand, my husband died. It was 3 years ago last week, and I'm really happy to live in the city, even though it's a little bit riskier than maybe living in Downers Grove or Lisle. But I do want to tell you, and this is the funniest thing, and I was telling Xavier, I got a call about half an hour ago from a woman, and she said, "Do you remember me? You did my mother's taxes for 30 years. Well, of course I remember her mother, and then her mother passed away, and I did her mother's trust, and I did all the work with the daughter who happens to live in Evanston." And she said, "I need your help for my father." She said, "I thought I'd ask you first. My father's tax preparer retired or died or went away." And she said, "We really, really need you." And what did I say? The tax preparer that cares about my clients, both my former clients and most of you, I said I would help them. So if you have been on the library workshop mailing list before, we are keeping you on our library workshop mailing list. If you want to receive our mailings, you can either call us or email me at judy@strausstax.com, or my newsletters, which we do send to you, are always posted on our website, www.strausstax.com. Having said that, and that's enough to say for now, I want to start by talking about giving you an introduction about what's going on. Part of the reason this is going to be a really difficult, horrendous, awful year is because the IRS is in crisis. In 2020 and in 2021, with COVID, they all worked from home. What that now means, so you have a sense, is that there are 5 million pieces of unanswered snail mail. So if you sent in your tax return in snail mail, if you replied to a notice, if for whatever reason you corresponded with them, it's sitting in some storage bin and opened a few at a time. The average response time when we send anything in paper is somewhere between 4 and 8 months. That's from last year. That's not from this year. There are also 8.6 million unprocessed individual tax returns from last year, and we're just starting on this year. So the IRS is a little bit nervous. We are very nervous because if you tried to call the IRS, the probability that you would get them on the phone is close to 0. I can stand on the line on the phone on my line, which is a practitioner line, for an hour before I ever get to somebody if I'm lucky. So this is going to be a very interesting and very, very, very challenging year. I will also talk about tonight that one of the things that's happening, that many of us are used to sending in checks to the IRS. And what happens to checks? They have to be processed by hand. And so a lot of the checks have gotten lost, or were never cashed, or were misplaced. And so one of the things I'm going to talk about later on tonight is how to pay the IRS on their website, and how to pay Illinois on their website. Because at least if you pay them that way, we know that they've gotten the check, and you know that they've already cashed the check. So I'm going to do a whole lot of talking about that kind of thing. But I have to tell you that when we talk about the changes, which I will in a few minutes, and some of the things that are going to happen, as well as some of the things that have already happened, it's going to be an interesting year. So before I start, I see the chat at the bottom. Is there anybody that has, usually what I do is I wave my hand and say, raise your hand and tell me your questions. So can you put them either in the Q&A in the chat so that I know what questions you might have? There are quite a number of you here, and I'd love to be able to answer your questions. Does anybody have a question for me? I don't see a single one. Okay, well, I'll go ahead. If you've got questions, please make sure you answer them. I will also tell you that Xavier is recording this webinar so that if you don't get your question answered, 1, you can listen to it again. 2, you can call us, and if we don't get back to you right away, we will get back to you, Beth or I, and I will answer your questions. Okay, so here is what's going on for 2022. In 2021, many of us got what we call stimulus payments. They were non-taxable payments that came from the IRS because people were really hurting. Either they didn't have any money, or they were sick, or they lost their job, and they were unemployed, and it was a disaster. So in 2021, there were 2 stimulus payments. They came, they were not taxable. But again, they were based upon your tax return from the year before. And one of the things that you had to do is you had to reconcile them on your tax return. What do I mean by reconcile? If you got the money that you were supposed to get, then you didn't get any more money. So you needed to know what you got in your 2 stimulus payments, and then the tax program or you would figure out what you should have gotten. And if that number matched what you got, then there was nothing else to do. If what you got was more than you should have gotten because your income was higher in 2019 than it was in 2020, you didn't have to pay back the stimulus payment. However, if your income was lower in 2020 than it was in 2019, like many people, then you might have gotten less stimulus payment than you were entitled to. And the extra stimulus payment would come back to you as part of your tax refund for 2020. Okay? There was a worksheet on the tax return for you to do what we call that reconciliation. Some people tried to do that workshop by hand. It was a mess. Other people had no idea what they were doing because they didn't know how much stimulus they really got or what the check was, that the checks were that they got either in the mail or direct deposited, or sometimes by a debit card, but not too often. And if you made a mistake on that reconciliation, your refund didn't come back right away. In fact, guess what? your refund took months and months and months and months to come back because somebody had to physically reconcile what you put down and what you should have gotten and then process the correct refund. We still have people that have not gotten their refunds from 2020 and 2022 because all of that backlog are people that made mistakes. If you were a client of Strauss Tax Service, we told you to do two things. One, go back and look at your bank account and figure out what you got so that you would be able to tell us what you had. You could look at your checks, you could look at your statements. If you're computer savvy, you could look online and find the direct deposit so that we have to put down what you officially got versus what you think you were supposed to get. And people's incomes varied a lot. So we really didn't know. And that's been part of the problem. In 2021, there was only a third stimulus payment. The official name of that stimulus payment is economic impact payments, but there was only one, and it was a pretty big one. It was $1,400 if you were single. It was $1,800 if you filed married joint, and $1,400 for each dependent. Okay, that stimulus payment had a phase out limit based upon your income. Again, it was based upon usually the filing status of the year before, $80,000 for single filers and $160,000 for joint filers. So what's going to happen again, and that stimulus payment showed up in the spring of 2021, either in a direct deposit or in a check, and sometimes in a debit card, but rarely in a debit card. In order to figure out your 2021 tax return, we're going to have to do the same kind of reconciliation. So they're still dealing with the backlog of the people that they haven't figured out from last year. And now we're going to have a reconciliation from 2021. Okay, well, the good news is that the IRS got a little bit smarter. One, okay, I see a question. I will answer that. I will answer that in just a minute. Let me finish about the stimuluses. Okay, so if what's going to happen, the IRS, and I don't know because I didn't get a stimulus payment. Did anybody get a letter from the IRS? It's called a Form 6475. Has anybody gotten one yet? Okay, I don't see a hand of anybody that's gotten one. Nope. Most people don't think that they've gotten one. Xavier said he didn't get one. You should get a letter if you got a stimulus payment. It should show up by the end of the month, and it should list the correct amount that you got for the third stimulus economic impact payment. Save the letter. Make sure you know. If you're somewhat computer savvy, you can go on the IRS website, and there's a place that said, what's my economic impact payment, or what's my stimulus? And if you put in all sorts of information, it'll pop up. It is easier to get the letter. It is also easier to look at your bank statements, and whether you do it yourself or I or somebody else does your tax return, you need to be able to reconcile that. That has been one of the biggest things that's been a problem. Now, again, it works exactly the same way that the one did the year before. If you get too much money and your income was higher in 21 than it was in 20, you don't have to pay it back. But if your income was lower in 2021 than it was in 20, which may have happened to quite a number of people, then you would be eligible for the balance of the stimulus payment, but only if you did the computation correctly. Otherwise, what's going to happen? We have 8.6 million returns that are still unprocessed, and your return could get added to that. Okay? And so this has been part of the problem. If we do not have the correct amount, the IRS by hand must recompute your 1040, and it could take months and months and months for you to get your refund. We have some people, and I'll talk about other things with the IRS, we have some people that are still waiting for their refund from 2020. We do. Somebody had a really important question over here, okay, so that I can answer that. It said, I just received a notice from the IRS stating they received my check from but not the actual return. It was paid with a check and cashed. So there are several things that are going on. If you file your tax return, which I'm going to recommend, by computer, which is called e-filing, I am required to file all tax returns by computer. If you owed money to the IRS, we put in our computer program to debit it on a specific day from a bank account. And then you can check on your statement, you can check online, they receive your tax return electronically, and then they match it with the payment. So it's an electronic system, which at least is the best way, even though the IRS computers are pretty darn old. I won't tell you how old, probably 20 years or 30 years old, but at least they get it. The question that this woman asked was the following. She said she just got a letter from the IRS that said they got her check for her tax return, but they didn't get the tax return itself. What do you think happened? One, somebody found that the tax return was probably sent in paper. So somebody probably opened up the paper and put the check in this pile, and those checks got deposited, and the tax return went into another pile, and either it got lost and it probably was never processed. And so there is no reconciliation between the tax return and the check. That's why the electronic is so much better and so critical, okay? And so, Eileen, did you send your tax return in paper? Yes, it looks like she did. And so, again, if you got a letter from the IRS that said, oh God, please help us, send us your tax return in again, then I would send it in paper. But I have to tell you, in our office, we do over 350 tax returns. And you know how many people don't want it sent in electronically? One. Because I am required to do that unless the person absolutely doesn't want it filed electronically. Again, when the things show up in paper, somebody's got to process them and take them and put them in the computer. Okay, and so that's been an interesting problem. So Eileen, I would definitely send them a copy of the tax return in the envelope that they gave you, and then somebody will match it. It doesn't mean that there's a problem. It just means they haven't coordinated the right hand with the left hand. And that's been an ongoing problem. Again, please, let me say this again, and it's kind of hard to understand, but the IRS is dealing with 20,000 less people than they had in 2010. Got that number? 20,000 less employees, okay? That means that there are less people to do the work. There's almost nobody to answer the phone, and everybody is still working from home on outdated computers. Yes, so Eileen, you should send the tax return by paper in the envelope they provided with a copy of the letter, and then they will reconcile it with your check. And what I am suggesting to every single person, and I'm not looking for new clients. I've been doing taxes for way longer than 35 years, okay? But I will tell you that you should have your taxes either done by somebody else or by computer software, or you'll forgive me if you feel comfortable with that, your kids can do your tax returns. They're much more computer savvy than many of us are. And again, one of the things that's happening even as I grow older is I'm getting all these calls that say, I used to do them myself, but I'm really scared to try and do them this year. I think I really need help. And I say, oh my God, there's only one of me. And I'm not too young, but I'm working really, really hard. So I am suggesting that you do them. That doesn't mean you understand what to do. That's why you're here. The second thing that's going on, which is a major problem in 2022, when we file 2021 tax returns, is something from the new tax law, from the American Rescue Act, and it's called child credits. Many of us probably don't have them, but this is something that I just want to let you know is what's happening. There used to be a $2,000 per person child credit for a child that was under the age of 18, was put in during the Trump Tax Act in 2017. And that was dramatically increased in 2021. It's going to be $3,000 per eligible child under the age of 18, and it's going to be $3,600 for each child under the age of 6. There is an income phase out for the children. And again, part of that reason that it was put into place is because my kids are old, my grandkids are old, I don't have any great-grandchildren yet. But when I look at what it costs to feed a family of 4, or they tell me what it costs to buy a pair of tennis shoes, I go, or when I check out at the grocery store and there's only one of me now, I go, and the cost is, huge. And so raising a family gets to be really, really expensive. So they wanted to help families with children, and they raised the child credit. Now it does phase out starting at $75,000 for singles and $150,000 for married, but the $2,000 credit doesn't phase out unless your income is over $400,000. And I probably have a handful of clients whose incomes are that high, not very many. The kicker in this, and they wanted to be good to people because people were hurting. So starting in July, based upon last year's tax return, okay, they started sending out what they call advanced child credits. It was half of the child credit that they thought you would be entitled to, and they started sending it out on a monthly basis, starting in July of 22, July, August, September, October, November, December. That's fine. You got a lot of money. So what do you have to do on your 2021 tax return? God help us. You have to reconcile what you got with what you should have gotten on yet another worksheet. So if you got not enough money, you will get some extra money. If you got too much money, you do need to pay it back. You don't need to pay it back unless your income is over $400,000. But what did I tell you about the economic stimulus payments? If the worksheet is incorrect, your return goes over here and then it gets moved to a pile that said, we have to check it. So if you don't get the amount of the child credit, what we call the advanced child credit, correctly, okay, they will either send you a correction notice, reduce your refund, or recompute your child credit. What does that mean? It means even though you're dying for the refund, you're probably not going to get it in a timely fashion. So it's really there's a place on the IRS website that I like but hate. It says, "Where's my refund?" And you can go there and try and find out whether your refund has been processed. And if there's a problem, it just says, "We're still checking on your tax return. Check back in a week to 10 days." So that's really cute, and it's a problem. What the IRS has done, I told you the first letter they're going to send you, and the IRS only, I'm going to say this really clearly and say it again, and then I'll probably say it again later on tonight. The IRS never calls. The IRS never sends an email. The only kind of communication you're going to get from the IRS is a snail mail letter. So they are also sending out letters for these child credits so people know what they got. And it's form 6419. You can also presumably, and I haven't checked it yet, but presumably you can also check online to figure out what you got. But again, it's not as simple as a stimulus payment because you only got one stimulus payment. If you got the advanced child credits, you got it every month from July until December, and they need to be reconciled on your tax return. So do you think it's going to be simple? I think it's going to be a mess. And if you were my client before, or were in one of my workshops, and we sent you my checkoff list, which some of you, if you want one, you can let us know and we'll send you one out. It says, please make sure you bring us the amount of your stimulus payment and the amount of your advanced child credit. Now, there's something else in there that's semi-tricky, and it's something that we did when we worked with clients. We suggested to clients, especially the younger people that seem to be making more money than we ever believed we would make, we suggested that they opt out of the advanced child credits, which means if they're going to get them, it will add to their tax refund when I do their taxes. But you could only opt out in July. So if you didn't opt out, then you got money whether you wanted it or whether you needed it or you didn't. And so people are going to be very, very, very confused about these child credits. So again, before you start doing your tax return, you need to know where your economic income payment is, the stimulus payment, and you need to know about these child credits. And if, I don't know how many of you are old like me, or if you're younger, but you ought to tell your kids, you know, it's not going to be as simple as you think it is. That's number two. Number three, I want to talk about something, and usually when I get clients in these workshops, they're, you know, my age. And my age is an age when you have to take out your required minimum distributions from your IRA. And I really want to talk about this because what the IRS decided, a lot of us have huge amounts of our retirement investments in either 401ks from work and or IRAs that we had, or that we rolled over our 401ks to when we left work. And so a lot of the wealth of the country is sitting in accounts that are right now not taxable. So a long time ago, the IRS passed a law, or Congress passed a law that said when you were 70 and a half, you had to start taking out a required minimum distribution from your IRA. And the way that was figured, it was figured on two things. It was figured on the value of all your IRAs and 401ks at the end of the year, and a table that the IRS has that's called the life expectancy table. And so every year you're taking out more, okay, because you're getting older. God help us, we're getting older. And so again, 2 years ago, during the beginning of COVID, they waived having to take out money. But in 2022, there's no waiver. You have to take out, or in 2021, you had to take out your required minimum distribution. And if you work with Fidelity or Vanguard or Schwab or Edward Jones, they usually tell you how much you have to take out. It's based upon the value of your assets, all of your assets in IRAs at the end of the taxable year, 12/31, at the end of the taxable year. It's based on that and this life expectancy table. Okay, what they have done, and there are a couple of things that I want to talk about with those IRAs. They also put in something else that's real important. When they passed the tax law in 2017, they doubled the standard deduction and got rid of all the exemptions. So unless you're really sick and have huge amounts of medical, or unless you give away huge amounts to charity, which many of us can't afford to do, lots of people are not itemizing their deductions like they used to before, when they used to bring me their clothes that went to Goodwill and all this other stuff, and sales tax on new cars and other things. That isn't happening. Okay, so that if you give really good money to your church, the probability, if you don't itemize, that it's going to help you tax-wise isn't great. However, they started a new thing that's really very helpful, and it's called qualified charitable distributions. So let's say your required minimum distribution from your IRA is $10,000. And what you used to do when you went to church, like St. Joan of Arc or some of the other really good churches in Lisle, every week they would pass around the basket and you'd put money in an envelope. Okay, and you'd come and you'd tell me, or they'd send you a letter of how much you gave to the church. Okay, if you don't itemize, that contribution doesn't count. So what you can do to make that contribution count is, instead of giving it from your right pocket, you're making that donation from your IRA. And your IRA trustee has to send the check to the charity or the church. And you can send it monthly, or I tell people just make one big contribution for the year and then don't put money in the basket every week. Now, churches used to, and other charities got used to getting money on a regular basis. Now they get big chunks one at a time, and they have to figure out how to budget their money. So this qualified charitable distribution is a very good way to save money, because it gets subtracted from the IRA distribution. To give you an example, I have a small IRA at Fidelity, and I think I have to take out $10,000 or $12,000 per year from that IRA. I gave, because I am still working, I gave almost all that money to charity. I filled out a form from Fidelity. I told them how much and where I wanted each check to go. And when I do my tax return, I will pop up a little box. You will get a form from your IRA. It's called the 1099-R. And it will list the gross distribution and the taxable distribution. Then I will pop up a little box on my computer, and it will say, I gave 1,000 to the Salvation Army. I gave 500 to the Humane Society in Hinsdale for my adorable little cat, whose name is Pumpkin, my new cat. You know, and I would then, that would automatically then subtract from the amount that was taxable. So I have been doing required minimum distributions and what we call QCD, qualified charitable distributions, for a long time. Now, the other thing that the IRS did in 2021, which is an important thing for you to hear in 2022, is they decided that, which is true, that we're all living longer. And so what they did was they issued new withdrawal tables with a longer life expectancy. And you will see them in 2022 when they tell you how much you have to take out. To give you an example, my husband, who passed away 3 years ago, he was in his 90s, and his life expectancy the last year when he was alive was 10. So he didn't have to take out this much, he had to take out this much. They are now, because we're all living longer and they're worried we're going to run out of money, they're giving us the opportunity to take out less every single year. And so there are the old tables and the new tables. And your IRA trustee or your tax person like me will be using the new tables to tell you how much you have to take out. Okay. Now, the weird thing about that is, and it makes me crazy, I didn't look at the stock market today because I didn't want to look at it. Okay. I really didn't want to look at it. However, the stock market was really high in December. And what happened in January? I went down a huge amount of money in my little IRA at Fidelity, probably $30,000 or $40,000. And I said, oh my God, what happened to that? Okay. But the IRA is based upon the value at the very end of the year, 12/31. And whatever happens after that, that's your problem. But you have to make sure that you take out the money. Now, having said that, if you have 3 or 4 IRAs, you don't have to take out a minimum distribution from each, although you could take out a minimum distribution from one of them that covers them all. So that what I do, if you were my client, when I'm finished with your taxes, I add up all your IRA values at the end of the year. I tell you what you need to take out, and then you decide where you want to take them out from. Okay, some people have some IRAs and CDs that are earning 2%, and you may want to leave the money in the stock market and take it out of someplace else. It doesn't matter where you take it out of, as long as you take out the full amount of money that you're supposed to take out. Given that, and I guess I need to say this because this is a funny thing. Sometimes I have people come in my office and they say, oh, Judi, I'm freaking out. I forgot to take out my required minimum distribution. And they say, I read what the Irs penalty is and I'm freaking out. The Irs penalty, believe it or not, is 50% of the required withdrawal if you don't take it out during the calendar year. Now, I don't want you to get scared. I just want to tell you that that's the law. What I tell people when they come in my office is, 1, don't get scared. 2, we're all human. 3, take out the IRA right away. 4, take out this year's IRA right away. And even though there'll be double, if and when the IRS would come back to you and say you didn't take it out, Judi would write a letter and say, you know, we're human. We forgot. We took it out right away and you got your tax money. So leave us alone. Okay. 1, I can tell you I try and reassure people. And 2, I can honestly tell you it's never, ever happened that they've gotten a letter from the IRS. So even though you forget, which we're all bound to do, okay, the IRS is less likely to come back to you. I'm just really careful about making sure people do that. The second part of what happened with IRAs when they did this expansion, and let me tell you this, they have us taking money out of IRAs whether we need it or not because they want the tax money, okay? And so they had to balance off getting less money because they changed the tables with figuring out where they were going to get more money. So here's what they did in 2020 to change the tax laws. And this is very dramatic and important to listen to. When somebody dies, like my husband died, and he had 3 children, it was a second marriage. So his children got half his IRA, and I, as the spouse, that's what he wanted. I got the other half, and I agreed to that. I am the spouse. I am allowed to take his IRA and merge it with my IRA and take out a little bit at a time. It's called stretching, okay? Until they changed the law, his children could also stretch the IRA. So you could take out a little bit at a time all the way through your life expectancy. When they changed the law, they decided that anybody that was a non-spouse beneficiary had to clean out all the money within 10 years. So if your kids are inheriting part of the IRA, they may be in their highest level earning capacity, and then they have to clean out the IRA within 10 years. That doesn't mean they have to take out an equal amount every year. It just means by the end of 10 years, there has to be zero in that IRA. So you could leave it all sit there and take it out at the end, but you don't have a choice. You have to take out the money. And that makes it really difficult. It's a lot of money. I have somebody now, and there are 3 daughters, and one of them doesn't have very much money, and somebody else has a huge amount of debt, and they are taking out more money than the youngest daughter, who happens to be in much better financial shape, and she's going to let it sit there as long as possible and take it out at the end. But the other ones are going to take out a lot more money up front and probably, unfortunately, pay off credit cards. So that's a really tricky thing. And again, these inherited IRAs are not simple. So those are those things. I want to see if there are any other questions before I move on. No, I don't think so. All right. So that's what's happening with IRAs. And I am just beginning to tell you, it's not very simple. Okay. Oh, the other thing they put in with IRAs, which is really interesting, but I don't think many people are going to do that, is when you retired and you didn't have any earned income, okay, or even if you worked part-time, they said you couldn't contribute to an IRA. And now, as long as you have even a small part-time job, you can make an IRA distribution no matter how old you are. Most people don't know that, but if we start looking at their tax return, and maybe somebody has a part-time job, and I say, if you put $5,000 in an IRA, which you can do until April 15th, then I figure out how much you'll save on your tax return by putting in that IRA. And I guess I want to say something else about all of that. A lot of us, including me, like to have money sitting in there. It's sort of like a comfort factor. I have a bank account with way more money. I could hear my husband saying, "Are you crazy? Why do you have that much money sitting in a bank account?" Well, you know why? It's sort of my little comfort zone, and I like to have it. So that if I say to somebody, if you want to put in a $5,000 IRA and it'll save you, I don't know, $1,500 in tax, it's not a bad idea. I'd rather put it in the IRA and save the tax money than give more money to the government. But again, if you were doing it yourself, you might not even think about that. If you were sitting in front of somebody or somebody else was suggesting it to you, and you had, I don't know, 20 or 30 or 40,000. I have people with $100,000 in their checking account just because they feel happier to have that money and know that it's there, God forbid, if they needed it. So again, that's what they did with IRAs. All right. I think something else, I'm going to talk about some other things that have happened that are real important. I'm looking at the time. All right. Something else that's important, very important this year, and is different than last year. I said a lot of people lost their jobs. A lot of people got unemployment. A lot of people got unemployment. In fact, I have to tell you, sometimes unemployment was more than their job, especially since they increased the unemployment $600 a week. And some people got $15,000 or $20,000 in unemployment. In 2020, they passed part of the tax bill that said the first $10,200 of your unemployment was not taxable. So that was a true gift because people really needed that money. They needed it to pay bills. They needed it for their mortgage. They needed it for food. They needed it for medical expenses. And so they passed that. That was another problem with processing returns in 2020. I am sad to say that if you collected unemployment in 2021, 100% of that money is taxable. 100% of that money is taxable, not only for the IRS, but also for Illinois. And so a lot of people who thought that, you know, what happened last year was going to happen this year, it isn't going to happen. And so people are going to get the form from the state of Illinois. It is called a Form 1099-G for government payments. And they say, oh my God, I didn't take tax out. Oh my God, I bet I might owe money, because they inherit the expanded unemployment benefits went until September 6th, which is really a long time. And so a lot of people got a lot of money. And so I can't tell you what will happen, but they're taxable both by the IRS and by Illinois. And a lot of people didn't have tax withheld. So, and there were a lot of people, whether they worked as servers or whether they worked, God forbid, as Uber drivers. I have a lovely friend. And as I said, my husband died and I have all these new friends all over. So one of my friends has a part-time job and he's an usher at the Chicago Symphony. He makes $15 an hour. He made more money in unemployment than he ever made as an usher for the Chicago Symphony. For a year and a half, he got unemployment from the state of Illinois because he wasn't a full-time usher, but he made a reasonable amount of money. I mean, it was a nice job. He loved the people. He got to hear, you know, the CSO play all the time. And he wore this cute red uniform, if you've ever been to the Chicago Symphony. And, you know, he loved the job. And he said it was kind of fun and he made money, which was very helpful. And it gave him something to do, you know, several days a week, usually like Tuesday, Thursday, maybe Saturday during the week. And it was all fine. So that's what's going on for unemployment. Some other things that are happening from the new law that I want to tell you are this. I don't think there's still any other questions. Okay. And this is another big one. Many of us who come on these webinars are not young, but we all have kids. I have kids, you have kids, I have grandkids. Many of us have grandkids or hopefully great grandkids. There was and there is a credit for what we call dependent care. That means if you have a child and you put them in daycare, or you have somebody watch them where you're actually paying them and then reporting the income, that dependent and child care can count as a credit against the taxes owed. Okay, it used to be a max of $600 for one child. Okay, and now, believe it or not, that child's credit, it's fully refundable at an increase from $600 to $4,000 for one child, and from $1,200 to $8,000 for two or more eligible children. That is a huge amount of money. So if your child is in daycare, there's a form called a 2441 that we fill out, and that credit gets subtracted from the tax you owe. So that if you're paying that huge amount for your child or for your spouse to be taken care of, okay, then you will get a credit up to that amount of money, which is a huge amount of money. It's the credit rate increased to 50% of what you pay. And I have quite a number of people, maybe not as many with COVID where they're all working from home, but when they weren't working from home, they were paying $10,000 and $12,000 and $15,000 for daycare for their kids. Now, I can't begin to tell you what it's like trying to work from home with little kids running around, but that has been done, and that is really, really important. They also increase the income eligibility for the credit It used to be up to only 125,000, and now it's all the way up again to 400,000 before it phases out. So it's really an important thing to know. Okay, and I usually remind people that that's available. Now, God forbid, and we'll talk about this again when we do medical, but God forbid you pay your next door neighbor and you pay them cash and you pay them under the table to take care of your kid. Is that deductible? Not unless you give them a 1099 and they report the income. So if you pay them cash, it's not going to work. The second part of this dependence care that's really important is that there is and was a part of the law that said if you were working, many employers had what we call pre-tax dependent care benefits. If you're still working, often your health insurance is pre-tax. It gets subtracted from what you pay tax on. Okay, and there was a pre-tax benefit of $5,000 of dependence care, okay, which is pretty awesome because that gets subtracted from what shows up on your W-2. There is a place on your W-2 where they list how much you put in, they're called DCB, dependence care benefits. And I need to reconcile that on your tax return. But again, that's an important benefit. That $5,000 was increased to $10,500. And so if you went to a tax person or you read my newsletter and you knew about that, I have clients that increased their DCBs to more than double, and that saved the money because it's pre-tax, means it never shows up on your W-2. So those are some of the really, really, really big things that have happened. Now I'm going to talk about some other things that you need to pay attention to. Okay, so far we still have no more questions. Okay, one of the things I love, I'm looking at the Lyle Library District over here, and I'm looking at myself over here. I wish some of you would at least put yourself in the chat and say, hi, Judy. I miss seeing you. I do. I used to love seeing you, and Beth and I used to love to say hello to you, and then people would stay after. So now if you really want to see me, you can call me tomorrow. Okay, so several things have happened. I think I mentioned to you, if somebody else said hello, hold on. From Jordan to all panelists said hello. Thank you. Okay, so here are some things that you need to understand, and these are pretty important. Okay, the rates are still low. I'm going to say this, and people, every time I talk to people, they say, oh my God, I'm paying so much tax. I've been doing taxes long enough that I can honestly say to you that this is the lowest tax rate that you will ever see in your and my lifetime. If people start really complaining, I go back to a folder that I keep with my tax rates, and I figure out what you would have paid before the year 2000, and they choke. Okay, it's really bad, but these are the lowest rates you will ever see in your lifetime. They talked about increasing them. They didn't do that. Congress is fighting between the Democrats and the Republicans, and there's lots of lobbyists. I can't promise you what'll happen, but I promise you they're never going lower than where they are now. They're probably going up, okay? But the other thing that's happened, and this is an important thing to pay attention to when you think about your own investments, is this. When you have what we call ordinary income is wage income on a W-2. Ordinary income is Social Security. Ordinary income is interest dividend income from banks. Ordinary income is IRAs. Ordinary income is pensions. That is taxed at the highest possible tax rate. There are other kinds of income that are called qualified dividends from stock and long-term capital gains when you sell a stock or a mutual fund, and they are taxed at a much lower rate. If your income is low enough, those qualified dividends and long-term capital gains are taxed at 0. And I'm going to give you an example of that in a minute. If your income is slightly higher, then your qualified dividends and long-term capital gains are taxed at 15%. And if your income is way high, then it might be taxed at 20%. But again, if you have money in stocks or you have money in mutual funds that are invested in stocks, that's how the rich people like Mitt Romney and Warren Buffett and many of those people pay a whole lot less than people that have money mostly in IRAs. And so the qualified dividends and long-term capital gains, it doesn't matter what you have it in your IRA. When it comes out of your IRA, it's ordinary income. If Judi Strauss Lipton owned a stock like Tesla, which I own, but I don't own it as much as some people, and Tesla started out here and is now worth way up here, even though I didn't sell it, that's called unrealized gain. But let's assume I wanted to buy a car and I wanted to pull $20,000 or $30,000 out of my holdings in Tesla stock, not in an IRA. The gain would be taxed at the lowest possible tax rate. So it's a really good deal for you to hold money in stocks or in mutual funds that are in stocks. So there's a difference between ordinary income and qualified dividends and long-term capital gains. And I want to say that. Okay, the second thing that I told you, and many people are not itemizing anymore because they doubled the standard deduction. It went up to $25,100 for couples, $12,550 for singles, and if you're over 65, which I am, it's an extra $1,350 for each one. If you're a couple, for each one of you, or somebody that's blind or somebody that's disabled, okay, above and beyond the standard deduction. If you remember, and I think I told you that your real estate taxes and other taxes are limited to $10,000. So many people are not itemizing anymore. It's one of the reasons I lived in Downers Grove. And one of the things that was interesting for me in Downers Grove is not where I lived, but there's a part of Downers Grove that's really lovely and has big lots and has huge homes. It's sort of in the northwest corner behind North High School. And a lot of people, and they have huge lots, a lot of people from Hinsdale were moving to that part of Downers Grove because you know what real estate taxes were in Hinsdale? They're $20,000 and $30,000 and $40,000. And they can build $1 million or a $2 million house in Downers Grove and pay probably 1/3 the taxes that they were paying in Hinsdale. And Downers Grove North is a very, very good school. So again, the standard deduction has eliminated a lot of people, and we'll look at the other flip side of that in a minute, but a lot of people aren't itemizing anymore. And because they doubled the standard deduction, there are no exemptions. Now, what there is that's interesting, and they did this in 20, and they're doing it again in 21 with a really crummy twist. Because they wanted to encourage people to give at least a little bit to charity, they said in 2020 that if you gave up to $300 to charity, you could deduct that contribution on the front of your 1040 is what we call an adjustment to income. So even if you gave 1,000 or 2,000 or 5,000 to the church or to someplace else, the most you could take was $300. And it was on the front of the 1040, which reduced your adjusted gross income. Why is that important? Because Illinois starts with your adjusted gross income. In 2021, they did something very, sneaky. One, they increased the $300 to $600. So if you're single, it's $3, and if you're married, it's $6. But they moved it to page 2 of the 1040, so it gets subtracted from your taxable income, and it's not before it hits the AGI. So if you don't itemize, then you're still going to get the $300 or the $600 subtraction, but it's not going to help you in Illinois. They were very, very, very stinky about that. And I did not like that at all. I just discovered it and said, that's pretty lousy. So again, now some people did the following, okay, and you can do this. Even if you didn't do QCDs and you give a lot of contributions away, you could give all your ones for 2020 away. And then in December, you say, oh, I'm going to give all of my 2021 contributions away. And that's called bunching your deductions. So in that year, you could itemize your deductions, and the next year you could take the standard deduction. So some people, I have a client that I love that got stock from work, and they could give away stock. They gave away stock to their church in December, and they bunched their deductions. And then when I did their taxes, I told them how much they saved by being able to itemize in 2020, and now in 2021, they're not doing that again. So they actually paid the contributions in 1 year so that they were able to itemize to be over the 25,000. Now, many of us can't afford to do that, but some of us can. And that's an important thing. So they're still deductible if you itemize your deductions. Now, on the flip side of that, and this is important, one of the things that makes people a lot itemize their deductions are medical expenses. And I want to spend more than a few minutes talking about medical expenses for you, because people, a lot of people would walk in my office, the itemized deduction form is like this, and the medical expenses part of the form is about that big. Okay, and they say, oh, I don't have any medical. And I say, I bet you have more than you think. Medical expenses, I wanted to find my checkoff list. Medical expenses includes the following things that are really big. One, it includes your Medicare. And I want to talk a little bit more about Medicare in a second, but it includes your Medicare. And Medicare keeps going up. It used to be $1,000, now it's almost $1,500. So if we have 2 people on Medicare without the drugs, that's already $3,000. We have your supplement to your Medicare, whatever that is, Blue Cross, Humana, AARP, and we have your drug plan. Now, some people have Medicare Advantage plans that are cheaper, and a lot of us feel like we really want to have the best insurance we can have so that, God forbid, we don't have to pay anything. And so just your medical insurance alone could easily be $10,000. Easily be $10,000. That does not include another type of insurance that's deductible, which is long-term care insurance. Long-term care insurance seems to go up 10 and 20 and 30% a year because, again, most of us are living longer. And I'm not saying anything about nursing homes, but they're incredibly expensive. I have clients that pay $5,000 and $6,000 for nursing homes. Now, your nursing home expenses are deductible if the primary reason you are in a nursing home is because you can't take care of yourself and do 2 out of 5 activities of what we call daily living. They're called ADLs. And so if you are in a retirement community and you are in independent living, then probably a very small percentage of your monthly fee is deductible as medical, and the retirement communities send you or they give us a letter so we know how much we can include as medical. If you're in assisted living, if you're in memory care, if you can't at all take care of yourself, like I have clients with dementia, then 100% of your medical expense at the nursing home is deductible. And they usually send us letters, and we recommend that our clients get a letter from their doctors that say, so-and-so is my patient, and I recommended that they be in this facility because they can't take care of themselves. And if we get the letter that says they can't do 2 of 5 activities of ADLs, which include getting up, feeding yourself, dressing yourself, bathing yourself, taking your own medication, then I can deduct all of the expenses. And so nursing home expenses can easily be $50,000, $60,000, $70,000 and more a year. I have a client who is a friend that passed away in October, and I think he was paying at Oak Trace something like $7,000 a month. What is 7 times 12? It's more than I want to believe. Okay, so that's one part of the medical expenses. If you have good insurance, then usually whatever Medicare doesn't pay, your insurance pays. But if you have out-of-pocket expenses for doctors, okay, or lab tests or other things, that's all part of medical. There are several, and out-of-pocket for prescriptions that you have to pay are part of medical. On top of that, there are a couple other things that are very pricey that a lot of people wonder are medical, and guess what? They are. The first one is, hello, my dentist. I had my first implant last week, and I thought I was going to fall on the floor when they told me what the implant was going to be. There's the work for the oral maxi dentist, and when that is all done, then there's a jacket crown, which is your regular dentist. So by the time I finished, I made 2 dentists pretty rich. And if you have more than one tooth, it can be a huge, substantial amount of money. And the dentist somehow never lets you walk out the door without either paying it with a check or putting it on a credit card. It's one of the things, and I'm not being political, but it's one of the things that the Obama administration was really hoping to include in the most recent tax bill that they were trying to pass. Dental bills can be horrendous. I have a friend, and he's not a client, actually he's a client because I did his taxes for nothing because he's a friend and has no money. And where is he getting his jacket crowns and his partial done? In Panama, because it's so much cheaper than when he got a price to have it done in Evanston. It's outrageous. He could fly to Panama and stay in some Airbnb and have all the work done a heck of a lot cheaper than having it done at a dentist here. So dental is one. The second thing is really hearing aids, and this frosts me no end. I don't have hearing aids, thank God, yet. And I'll say yet because many of my friends and many of the people that are my clients have hearing aids, including my husband, who said, "Oh, you mumble. Oh, I don't know where they are. Oh, they bother me. I'm not using them." And so then he couldn't hear me anyway. But good hearing aids cost $4,000 and $5,000 and $6,000 a piece, and those are deductible as medical expenses. Okay, so if one of the things I recommend to my clients, and you'll see this in my newsletter, which we're going to be sending out in about a week and a half, it's going to the printer tomorrow. I strongly recommend that you look at what you're spending for medical expenses, whether you itemize or not, because I think you'll be flabbergasted at, if you're a middle income person, what percentage of your actual income is going for medical. I think you will be surprised. A lot of my clients say, oh my God, no wonder I don't have any money. By the time I finish paying my insurance and my dentist and my other stuff, that's why there's no money left in my life. Okay, and so it's a major problem, but I think it's a good exercise in budgeting and in financial to look to see what you have. Now, the other thing that I didn't mention was eyeglasses. Some people have insurance for that, but a lot of us don't. And even if you choose, and I have a client, actually they live in outside of Milwaukee now, but every time there is a health issue, they choose to go to Mayo Clinic in Minnesota. Their transportation to Mayo Clinic is deductible. Their hotel in Mayo Clinic is deductible. Okay, it doesn't matter where you go. Somebody was asking, they had a med van for their husband that went from their home in Florida all the way back up to Illinois because he was so sick he couldn't fly. Is that deductible? Absolutely, it's deductible. So again, when you start looking at this medical, and we talk about the $25,100 for the standard deduction, the clients I have that itemize are either the ones that have given big contributions or have huge numbers of medical. And when you have huge amount of medical, often you're paying the doctors and the nursing home. And so your tax winds up being either very low or zero. And so the medical is really, really huge. And I recommend that you all look at that when you're doing your taxes. I guess I want to say something else that's about medical, but it's not a tax issue. I have clients that ask me this question. They say, should I do a Medicare Advantage plan? Should I go on a cheaper plan? Should I cut my long-term care? And one of the things I tell them, and it's your own decision. But if you pay less over here, you're fine if you're well. If you get sick and you have a cheaper plan over here, then you're going to pay a lot more over here out of pocket. And as soon as you go to a cheaper plan, it's really difficult to get back. One of the things that Blue Cross had in other places, they had a plan F, which was the best, their gold-plated plan. And a couple of years ago, they got rid of it. It was replaced by a plan G. And plan G is okay, only the rates keep going up more than plan F did. But a lot of people are taking these Medicare Advantage plans. And one, they're fine when you don't have any medical problems. Often the doctors don't want to take them because they're not getting very much money from Medicare for those plans. A lot of them opt out of Medicare altogether. Okay. And two, if you're sick, then the medical bills are enormous. They are enormous. So that's where that is. I think the last thing that I want to say, and then I want to talk about paying online, is a lot of people ask me, oh, somebody has a question. Hold on. Okay, that's that. And somebody has a question. IRMA charges, I think. Okay, I think that's an important question. Okay, I want to go back to Medicare. And that's what this question is. Okay. Somebody said, okay, I'll look at what somebody said in a minute. But there is something else about Medicare that's important. And I didn't mention it, but I will now. If you are above a certain income level, and it's 80,000 if you're single, and it's about 170 if you're married, you start paying more for your Medicare. What Medicare does is, and Social Security, is they share information with the IRS based upon what's called your modified adjusted gross income, which means your income at the bottom of your 1040 plus all your tax exempt income. And they look at that number and they figure out whether you're below the minimum amount to have more. Hold on, I don't know where this is. I have it someplace. I don't know where it is. It's sitting, I'm not going to look at it now, but it's more. And so what happens is they share this information and they send you a letter. Turns out to be usually right around Thanksgiving when you're beginning to feel like you're ready to spend money for Christmas. And you say, hello, Judy. We've looked at your income from your tax return, and we see that your modified adjusted gross income is this. And so your Medicare, instead of this, is now this. And it's this more for only 1 year. Okay? So that if you decide you needed a new car and you took out $50,000 out of your IRA, or $40,000 or $30,000 to buy a new car, or you say, I want to take a trip around the world, which most of us aren't going to do, then your income is indeed much higher. And for that 1 year, you will pay more for Medicare. And then the next year, if you're not going to do that, it will drop. Let me give you an example of that. That I have a client that thinks she's going to get out of it, but she won't. She actually lost her job, and she's my age. She's a friend and a client, but she actually lost her job in August of 2020. And they gave her a buyout, and then she had a loan against her 401k that she couldn't afford to pay back. So on top of her income, plus the buyout, plus the $50,000, her income was much higher than it would have ordinarily been, because if you have a loan from a 401k and you lose your job and you can't afford to pay it back, it gets kicked back in as income on your W-2. So you may not like it, but that's what happens. So one, you don't have the money until you got to pay tax on the money you don't have. And so again, you get this letter from Social Security and Medicare that says, hello, you have to pay more, but it's only for 1 year. The question that was down there in the Q&A said, if I am paying more for Medicare, is it deductible as medical? And excuse me, the answer is yes. You're not only paying more for medical, but you're also paying more for the drug plan. And what it does is they figure out how much you're paying, and then they reduce the amount that goes in your bank account from Social Security every single month. And while I said the IRS is a mess in terms of them processing returns, I am telling you Social Security and Medicare are rock on this. Every year it shows up in December. Okay, but if you're going back down to the normal amount, then you're not going to get a letter. You only get a letter when your Medicare goes up. So if your Medicare will go back down because your income dropped, then you won't get a letter. Now, my friend is trying to challenge it because now she doesn't have very much income. She's out of work and she's retired. She's not living on very much income. But I don't think they're going to get rid of what they did. So we'll see. But that was the question that was asked about IRMA. Let me see. There are a couple other questions. Let me see. Okay, so that's the question. Are IRMA surcharges deductible as Medicare? And I said yes. Okay. So that was a very important and good question. And as I said, hold on, I just blew that. All right. So that's that. I think the last thing that I really want to talk about, and I'm two things. The first one is gift tax, and people are very, very confused about gift tax. Okay. What happens is a lot of people want to give money to their kids, to their grandkids, to whoever. What the law says is the following. The law says that if you give away more than $16,000 per person per year, then you have to fill out a form called a 709 and report the gift to the IRS. It is not taxable unless it hits more than $1 million when you die. And so when you die, they reconcile the gift tax with how much money you have. And then it reduces the what's called the death tax or the estate tax exclusion. Let me give you one. So again, if somebody gave something away, then I would have to fill out a 709 form, but there is no tax due at all. That's just the law. When people get scared, they want to give away money. So it costs $100 and some for me to fill out a form, and I have to send it to the good old IRS that goes someplace where, and actually that form, believe it or not, is to be sent in paper. I have no idea what they do with it. Now, back when, a long time ago, when the estate tax exclusion wasn't $11 million like it is now, it was 675,000. I had an absolutely wonderful client who had a lot of money, and she was sort of scammed. She had a bogus charity friend, and she kept sending money to this charity that I kept telling her was bogus. And she was very lonely. Her husband died, and Diane would call her all the time. And one day she called me up, this was many years ago, and she said, Judy, I think I goofed. And I said, what did you do, Fran? She said, I bought Diane a car. And I said, Fran, what kind of car did you buy, Diane? And she said, a Mercedes. So Mercedes was $90,000. Did I have to fill out a gift tax return? Absolutely, I did. When she died, did I have to tell her 3 children that we had this problem and that we reduced to 675,000? I did. Okay, that isn't going to happen now. Okay, but it did happen back then. So if you give money to your kids, you don't have to get scared about doing that. You just have to know you have to tell me, and then I have to fill out this form. And the reason I have to fill it out is because that's the law, and I am an enrolled agent, and I have my professional responsibility to comply with the IRS regulations. Okay, so that's the estate tax and the gift tax. Now, the other thing I want to say about the estate tax, okay, it's 12.6 million in 2022. Most of us are not there, but many of us have more money than we ever thought we would. And I have to tell you, for better or for worse, good old Illinois is only 4 million. Now, 4 million sounds like a lot to many of us. For some people, it doesn't. But the estate tax in Illinois is 4 million. So to give you an example, I had somebody that didn't have to pay their federal estate tax, but they did have to pay money to the state of Illinois. And so I had to fill out the form that's called the 706 for the federal, because the Illinois 700 works off the federal. So again, a lot of planning. I do have one client where his mother and his father and then his mother died, and she gave a huge chunk to charity. And so she didn't have to pay any tax because she gave it to charity as well as her kids. So that's the estate tax. The last thing that I want to talk about is paying the IRS. And this sort of follows the loop. I will, like I told you before, that if you or I are doing your tax return, I would probably tell you 85–90% of them are done by what we call electronic filing. The advantage of electronic filing is the following. If I am doing your taxes, and my tax program, different than TurboTax or H&R Block, costs $2,000. Okay, it's a professional program. And one, not only do I know what I'm doing because I'm an enrolled agent and I take 30 hours of courses each year to make sure I know what I'm doing for me and for you. And I have $2 million worth of insurance, liability insurance, okay? But my program will check to make sure there are no errors. When we electronically file the tax return, it comes back to me within a day or 2 days as accepted. That says that it's passed the first level of IRS due diligence, and Beth calls you and says your tax return has been accepted. That's different than if it shows up in paper and you never know what's happened with it. So the very first thing that's really good about the IRS e-filing is that you get an acknowledgement and we let you know that it's happened, whether you do it yourself or we do it and then we call you. That does, and if it's e-filed, then we can both put your refund directly into your bank account or pay them online. And you can check online and see that the money is either gone out when we say it's going to gone out, or two, within a week or 10 days or 2 weeks, you can watch and see that the money has come back in your bank account. Again, they don't keep that information and I don't keep that information on my computer. That's a one-time thing. And again, that works. If you do it by paper, you really never, ever know what's happening as you go along. So e-filing works really well. E-filing doesn't ensure that there might not be a problem. So I might get a call from somebody later on and say, oh, you know, and I got one, we're still dealing with it. Oh, you know, I forgot to tell you that I took $100,000 out of my IRA to buy a condominium in California. I just got this letter from the IRS that said, this is what you put on your tax return, and this is what we found, and essentially this is what you owe us because we recomputed your tax return. So if you forget something, anything you get in paper between now and like February 15th, the IRS gets a 1099 INT, a 1099 DIB, a 1099B for a stock sale, a 1099R for an IRA withdrawal, a 1099R for a pension. They get any one of those forms that you get, they get. And eventually their computers check what's on your tax return and what they received, and they send you a letter. Okay, and so that doesn't prevent that kind of thing from happening. We can always do an amended return. Somebody will call me up and they say, oh my God, we filed this return and I just got something else in the mail and I forgot about it. I can file an amended return. But if you forget, they will come back and get you. So e-filing becomes really important, okay, for all of us. And I have to tell you, it is incredibly secure and works really well. We e-file the federal, we e-file the Illinois, we get our acknowledgements back, and then Beth calls you. And you can pay what you owe. Many people pay when you are working, many people have their withholding from their W-2s, and many of us, when my kids were young and I was divorced, I loved getting tax refunds. Do you remember when you used to get them and you used to get checks in your mailbox? Like, oh God, I'm ready for that. Now, many of us have to pay, especially when we're retired. Money is coming in from all sorts of different places. I call it multiple income streams. And often you're not having enough tax withheld. And so many people that I know, including me, are paying what we call estimated taxes. You may ask, why would we pay estimated taxes? Well, there's an important reason. One, the government has bills. They need to pay their bills. They're not doing a great job, but they need to have money coming in. Imagine what would happen if you were working and your employer said, oh God, we can't pay you this month. We can't pay you next month. We'll pay you in December. And you say, no, 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 I have my mortgage due. I have to buy food. I have to pay the doctor. Okay, the government has the same requirements. And what they say for estimated taxes is you have to pay at least 100% of last year's tax return or 90% of this year's tax return, or there's a penalty. When I work with you or my clients, we really try hard to figure out what the estimated taxes might look like, and then you pay them 4 times a year. You pay them in April, in June, in September, And the final one is in January of 22 that counts for the end of 21. And until last year, most of us, including me, I would give you a little coupon and I would give you envelopes and I would give you worksheets and you would mail them into the IRS. Given what I've told you before, okay, the IRS and Illinois are having a problem with paper checks. So they have now set up a system where you can pay your estimated payments online without setting up an account for the IRS in Illinois. You can go on their website and there's a place that says, make a payment. And you walk through it. We actually have set up a whole page of instructions that we'll be giving you with your estimated tax worksheets, but we are, I won't call it strongly recommending, probably just recommending that if you think you can do it, or you will need help and we can help you do it, or your kids can help you do it, that you set up your payments online and then check and make sure that they're debited from your bank account. I just paid my fourth quarter estimated for the IRS in Illinois, and I checked and made sure that they, one, that they came out of my bank, okay, and two, that we're all set to go. So this, and they send you an email confirmation that they've received your payment. I think a lot of people are a little bit nervous about it. I will tell you that I was nervous about it. Many years ago, I had an interesting problem. I sent a check into Illinois in January. I never checked my bank online. This is before I got incredibly anal. And when I filed my tax return, which was like in July or August, I got a letter from Illinois that said, we never received your fourth quarter estimate. And sure enough, it never got cashed. So I sent them the check, okay, and I paid the penalty. And the next year, you know what happened? They cashed two of them. They found my check from last year, and then they cashed the old one. And so I called them, and they eventually sent me back the money. But if you pay online, it is a lot easier. If some of you are not sure how to do that, and you're not my clients, I'll be more than happy either to email you or to send you our online paying instructions, because I'm strongly recommending with the problem that this woman was having, that things are, if you think last year was bad, I will tell you when I talked, and I have trouble getting through to the IRS, but I had one woman the other day in December that said, oh, thank God, I only have 10 more days. I'm retiring, I'm retiring, I'm retiring. Okay, the people that have been there a really long time can't wait to get the H out of there because it's so stressful for them, and they really care about helping us. So there are less people there to do the work, and the IRS doesn't have money to hire any new people, and their computers are really old. So we are strongly recommending that you learn how to pay online, and that at least you know that the stuff has been cashed. I'm going to stop for a couple of minutes and see if anybody else has other questions. Do I see any other questions down there? I don't think so. Okay, so I want to finish up. And as I said, I think Xavier is going to have this on a program that you can look at again to see if you have other questions. But I'm going to say this again. Hold on. If people want my newsletter, they can do one of two things. They can send me an email through my website, and I will be happy to send the newsletter back. The newsletter that I just finished is going to the printer on Thursday, and I will be more than happy to either snail mail or email it to you, so that you can get on our mailing list. If you want it snail mailed, then give us your address. and we'll be more than happy to do that. Usually within a week of when we get them mailed, they are on my website, and you can go to my website. It's www.strausstax.com, and you can click on the drop-down bar and you will find the latest newsletter, and then you can print it. The good news is I have a wonderful IT person, and somehow I seem to be very Google optimized, which isn't all bad. Hold on. What's this thing? Which isn't all bad. And so, yeah, thank you, Xavier. That's my website. And so you can find me there. Most of you can also find me. I don't post my newsletter there, but one of the things that I love to do, I have a Facebook page for Strauss Tax Service. You don't need to be my personal friend. Don't need to know what's going on in my personal life. But a lot of the things, when they happen real time, I will post them on my Facebook page, or I will post articles. And Xavier just put up my Facebook page as well. And a lot of you are Facebook friends of mine. If you look at my Facebook page, I think one of the things I love, and the woman, first of all, there is a person that's on this Zoom call. I'm getting interviewed for a story by a Northwestern graduate student in the Medill School of Journalism today. And she's on this, this Zoom workshop, so I'm really excited that she's there. But one of the people that's on my I think on my Facebook page, he has been my client since before he met his wife. And then he got married. First he met her, and then I did his tax return, and then I did her tax return, and then I did their tax returns. And then they used to have the cutest thing. They'd come to my Downers Grove office, and they'd call it date night, tax night, and they'd get a babysitter, and I do their tax returns. Now what do? I do their tax return, and I do the tax returns for all 4 of their kids, 3 of whom are married. And so we have a marathon. It takes half a day to do everybody's tax return. And you'll see he said he's been a client long enough that his original refunds were on clay tablets. He's very funny and he's really cute. And she's going to get to talk to him today. But I just texted him today and he says, oh yeah, we're getting ready for you. And I have 2 of his kids live in Wisconsin and we Zoom with them. And so that's cute. And so you're more than welcome to get my stuff. If there are questions, I want to say this honestly. If there are questions that you have that are more generic, and you call me on the 964-4018 number, I will answer them. If there are specific questions related to your tax return, I cannot answer them. I want to say this to you really clearly about me. I'm an enrolled agent. I'm not required, but I do. I have 2 kinds of insurance that are, well, actually 3, but 2 that are important to you. 1, I have liability insurance in case, God forbid, I make a mistake and somebody sues me. That's called errors and omissions liability insurance. And in all the years I've ever been in business, even though I've had it and it's a fortune, it's $2 million, I've never used it. I have a second kind of insurance, whether you use me or somebody else, that I think is a really important kind of insurance to have, and that's security protection insurance. You're looking at me through my main computer, not through my laptop, not through my phone. I have 300 and some odd of you as clients. I probably have people that haven't been my clients. I have one that's coming back. That last was my client in 2016. Her husband died and she called me up and she said, oh God, I need you. I said, okay. And then we found where she was and she's still in my computer. So I have 500 or 600 people, tax returns with your social security numbers and your financial information sitting in my computer. If your identity got stolen because somebody stole your check or somebody got into your credit card, that's only one of you. If somebody got into this computer, I could be ruined. You could sue me. I have several $1 million of what's called identity protection insurance as well as I have huge firewalls and all sorts of IT protection. I do not have your tax returns. I have them on my computer. I have them backed up to a hard drive, and I now have them backed up to what we call a private cloud. I spend a huge amount of money to an amazing IT kid, I call him a kid, who makes sure that I am protected and you are protected, because again, we're real worried about my security and I'm real worried about your security. And so again, whoever you have to use to do your tax return, it's real important that they have that kind of system in place, because if people hacked into a computer or got your credit card or got your social security number, it is a major problem. Okay, I'm going to leave you with one final story of that. And this was several years ago. I have a client whose parents in Downers Grove were my clients. They were wonderful clients. And when they inherited money, they became my clients. And they lived down in near Peoria in Morton, Illinois. And I never did their taxes before, and I did their taxes and I e-filed them and they came back rejected. And I went, okay. And I thought, what did I do that was wrong? What we discovered when I did my due diligence to find out what happened, she's retired now, but she worked for Morton College. I don't know, it was Morton, some college in Peoria, okay? And what happened is somebody hacked the computer at the college and stole everybody's identity and filed tax returns with the social security numbers from people from the college. So one, we had to send in their tax return by paper. Two, they got what's called, which they've had every year now, an identity protection pin, which you can get whether you've been hacked or not from the IRS. If you're nervous, you can get an identity protection pin that I put on your tax program that allows them to know that you are who you say you are, okay? And three, believe it or not, the university president got fired. And so again, these are the kinds of things that are important for you to think about when you hire somebody. As I said, I've been doing taxes for way too long. I have lots of wonderful clients from Ryle that have been clients forever and are new clients. If you want to come to visit me in Downers Grove, we're taking a limited number of new clients. The Downers Grove office is only going to do in-person clients. If somebody wants to Zoom or wants to talk to me on the phone, you can drop off stuff. I'll do them in my Chicago office. And probably we did 30 or 40% of the tax returns last year by Zoom or by phone or more than that. And so then I can share my screen with you. Many of us are very pretty sophisticated on Zoom, much more than we used to. There's a little button down here that says share screen, and I can walk you through your tax return while we're on the computer, and then we would send it to you. The only thing that happens, and I need to be very honest about this, Beth and I haven't figured out fees this year, but if we're doing your tax return and then we're picking up and then we're delivering and then we're Zooming, it's not just doing the tax return, we're actually spending more time doing other stuff. And so my fees are going to reflect that, because there's lots of time and you send me emails and you call me up and you're missing something and I'm checking and they say, oh God, I say, what did you forgot this? And they say, oh yeah, I'm scanning it to you. And then I have to download it. And so when I send you a bill, it includes the forms on the tax return and then a section that often says other work. And what I try and do is keep track of the time that I spend to do other work. And I just bill you at my straight per hour rate. I wish I didn't have to do that. I will honestly end this by saying, I hope you're all healthy. believe me, I and you and all your family and all my friends wish that COVID were over and we could hug and spend the time and go on vacation like we used to. But here we are, and if you're healthy and well, my heart is with you, and I hope you will continue to be so. If you've got any other questions, I will be around. If I'm not in the office, right now, Beth went home. She just texted me and said she got home, believe it or not. This is what a wonderful office manager I have. She's been driving to Chicago. I pay her to drive to Chicago. She was here all day, and she probably got home about 7:30 or 7:45. That's a long day, and she's doing it because she loves me, she loves you, and I couldn't do this business without it. So for all of you, thank you for coming, and I look forward to seeing you in person next year. Bye.